All right, let me ask you something. How is it possible that a crypto token priced at just 1 cent could actually be way more expensive than another one that costs $100? I know, it sounds like a riddle, right? But it's not. It's actually the key to understanding how crypto is really valued. So today, we're going to unravel that mystery. We're going to break down the critical difference between two little things called market cap and fully diluted valuation, or FDV for short.
You know, there's this really common trap in crypto, and honestly, it has cost people a ton of money. It all comes down to a simple misunderstanding, a mix-up between value and price. But get this wrong, and man, it can lead to some really, really bad decisions.
So, back to our question. How can that 1 cent token be more expensive than the $100 one? Well, it's not a trick. It's just the fundamental truth about how you value these things. It's all about looking past that flashy sticker price. And trust me, by the time we're done with this, you'll get it completely. And even better, you'll know how to spot it yourself.
See, we all have this thing called low price bias. It kind of messes with our brains. You see a token for, I don't know, a couple cents, and you immediately think, oh, wow, that's cheap. It could totally 100x from here. But here's the thing. The price by itself means almost nothing. The real keys to figuring this puzzle out are market cap and, you guessed it, fully diluted valuation.
Okay, so let's dig in. First up, market cap. The easiest way to think about this is its now value. It's basically a snapshot in time. It tells you what the entire market thinks a project is worth, but only based on the tokens that are actually out there, that people can buy and sell, like today.
So yeah, market cap only counts the tokens that are actively circulating. You know, the ones on exchanges that you and I could go and trade right this second. It totally ignores all the tokens that are locked up for the team, or tucked away for the big investors, or saved for some future rewards program. It's just a picture of today, and only today. And the math? Super, super simple. All you do is take the current price of one single token and multiply it by the number of tokens that are out there in circulation. That's it. Boom. You've got the project's value for today.
And this chart, it shows you the biggest problem with market cap perfectly. Look at it. That little colored slice is all market cap sees. It's often just a tiny, tiny fraction of all the tokens that could ever exist. It's literally the tip of the iceberg. And we all know what's dangerous about icebergs, right? It's the huge part you can't see, lurking right under the surface.
So that hidden part of the iceberg, that's what brings us to our second and honestly our most important metric, fully diluted valuation, or FDV. If market cap is the now value, then FDV is the future value. This is the one that shows you the whole complete picture, including every single one of those tokens just waiting to come out.
What FDV does is it calculates a project's value as if every single token that could ever exist was already out on the market trading at today's price. I'm talking every token for the founders, every token for the venture capitalists, every token for future rewards, all of it. It's the total, theoretical, what-if value. The formula for this one is almost the same, but there's one massive difference. Instead of multiplying the price by the circulating supply, we multiply it by the maximum supply, the total number of tokens that will ever be created. This number gives you the project's ultimate, full, long-term valuation.
And here you can see the difference, plain as day. Remember that tiny little slice from before? That was market cap. This is FDV. It's the whole pie, the entire thing. It's the value of the project if every single token was in play. And let me tell you, understanding the gap between that little slice and this whole pie, that is everything.
Okay, so let's recap. We've got the now value, which is market cap, and we've got the potential future value, which is FDV. The real magic, the thing that every investor needs to look at, is the gap between those two numbers.
Let's try a different analogy. Think of market cap like the cash you've got in your pocket right now. It's what's available to spend immediately. But FDV, that's like your total net worth. It's the cash in your pocket, plus all the money in your bank, your stocks, your house, everything. And as you know, the difference between what's in your pocket and your total net worth can be absolutely massive. So why does all this future supply matter so much? It's because of this really powerful and kind of scary thing called dilution. Just look at this step by step. Let's say today you own 1% of a project. Great. But then a massive unlock happens and a flood of new tokens hits the market. You still have the same number of tokens, but suddenly your slice of the pie, your ownership, has just shrunk from 1% all the way down to 0.1%. Ouch.
Now, there's a really easy way to measure this risk. It's called the dilution ratio. You literally just divide the FDV by the market cap. If you get a low number, like 2x, okay, that's probably manageable. But if you see a high number, like 20x or even higher, that is a gigantic red flag. It's basically screaming at you that a tidal wave of new tokens is on its way, which almost always puts huge selling pressure on the price.
So the big question is, how do we actually use all this to make smarter, safer decisions? Let's turn what we've learned into a simple toolkit that any of us can use. Okay, let's finally solve the mystery from the beginning. Take a look at this chart. Look at token B. It's only 10 cents. It looks so cheap, right? But look at its FDV, $4 billion. Now look over at token A. It's $5 a pop, but its FDV is only 400 million. They have the exact same market cap right now, but token B is secretly valued 10 times higher and is carrying a mountain of dilution risk. That cheap 10-cent price, it's a total illusion. It's hiding a crazy high valuation.
So here are the big red flags you absolutely need to watch out for. First, a huge gap between market cap and FDV. Remember that dilution ratio. Second, a tiny circulating supply. Like if less than 10% of all the tokens are even out yet. Third, check the unlock schedule. If the team and VCs are about to get a huge dump of tokens, watch out. And finally, if a project's valuation just seems to be built on pure hype and nothing else, be careful.
And really, that's what this all boils down to. The price you see is just noise. The real valuation, that's the signal. You know, in a market that's driven by hype and stories that can change overnight, just taking a second to look past the sticker price, to see the real numbers, it's one of the most powerful things you can do to protect yourself. So from now on, whenever you see a token that looks cheap, I want you to stop and ask yourself one simple question. What's the real price I'm about to pay?